is the market overreacting to the rescue capital that's being pumped into the system and maybe undervaluing the possibility that this economic recovery is going to be slower and more tepid and more tentative than anybody could imagine? I'm not saying depression, but I'm saying maybe prolonged demand destruction, particularly in the consumer economy, that makes the recovery weaker than some expect.
We think so, and we at least think what's interesting is, we put a number out there for earnings for year end of around 115, which, admittedly has a wide error band around it. It might even come in a little bit lower than that. I mean, when you look at where the market was today at the peak, based on those earnings, I mean, you were trading at close to 24, 25 times. And then you've got to have a fairly heroic recovery next year from a forward price to earnings multiple standpoint to justify anything in these areas by year end. So, we did have a year end target of right around 27.60. So we think at some point these levels make sense. In the short term, it seems to be more about front running the Fed, which, again, we saw that from October to January when they started to step into repo and expanding their balance sheet. So we've seen this movie before. We know how it ends, and it basically ends eventually with the market succumbing again to the fundamentals, which we just find weak. So we would take this opportunity to sell those areas that maybe you didn't get a chance to. So energy, materials, industrials. We would take this opportunity to kind of shy away from those, even small caps. And maybe you can start to step into some of these other areas where maybe the Fed's starting to give them a nice warm, embrace around high yield. Spreads there are fairly wide. You're at least getting paid to wait. So we actually rolled something out today that took money out of small caps and put it into high yield. We feel like that's maybe a better way until you get to the other side of this volatility.
How about that idea, Ron Insana, of selling maybe some places where you have losses in your portfolio, culling some of the losses if you now have some, taking out some of the positions that you might not like, and either moving to cash in light of what may be ahead, or moving into some other high-quality areas of the market? What do you think?
Yeah, I absolutely think that's true, Tyler, and particularly in the credit markets. Now that the Fed is buying investment-grade securities, buying munis, I think you buy what the Fed buys for all intents and purposes, and I think there are a variety of vehicles that would allow you to access that. I do believe that that's probably the way to go, and the same is true for equities, that, again, you focus on quality, fortress-like balance sheets, solid prospects in the future. And that's something actually we've been discussing now for over a year and a half, which has made sense all the way along. I do think the bigger question with respect to just market behavior is whether or not we find a biologic solution, whether it's a therapeutic in the short run or a vaccine in the long run, that's going to determine really the arc of economic growth and the behavioral aspects of this particular shock that we're suffering through. Some people think it'll be short-lived and we'll snap right back into action. Others believe that it may change our behaviors for some time to come. And I think that's as much as the Fed is preventing a liquidity crisis or a financial crisis, I still think the bigger question might ultimately be both biologic and behavioral.